Hello everyone and welcome to Financial Accounting. Our topic today is revenue as a contract and performance obligations. A contract is an agreement between two or more parties that creates enforceable rights and obligations for both parties. Revenue earning and subsequent recognition is the direct result of a contract between a seller and a buyer. The seller has specific responsibilities that must be fulfilled before the transaction is complete, regardless of whether that agreement is written or implied. Once all responsibilities are fulfilled, revenue from the transaction can be included in the selling company's financial statements. There are some complications in the revenue recognition process. We discussed the simplest example of revenue recognition in the video Basics of Revenue Recognition. I'm posting the link here and in the description box for your reference. We discussed that most of the uncertainties are removed when a customer physically selects a product, pays cash, and leaves the store with the product. In that example, revenue is considered earned and appropriately recognized by the seller, even if there are some continuing uncertainties. These uncertainties may involve the right of return by the customer, payment of amounts purchased on account, warranties, and more. The financial implications of these uncertainties can usually be estimated and don't delay the revenue recognition process. Let's look at an example. Assume an automobile dealer sells a vehicle with two additional services. One of those services is an extended warranty for 2 years beyond the manufacturer's 3-year warranty. The second is an optional agreement to service the vehicle for the first 3 years. The contract with the customer includes purchases of both the extended warranty and the service agreement. Therefore, the automobile dealer has 3 performance obligations: to deliver the vehicle, to complete any warranty work required by the extended warranty agreement, and to service the vehicle for the designated period. The automobile dealer needs to allocate the total amount received among the 3 revenue streams and recognize each as performance obligations are complete. Assume the total transaction amount is $35,000. The extended warranty is estimated at 5% of the total price, less the amount of the service agreement, which is estimated to be $400 per year. Revenue would be recognized as follows: vehicle delivery, $32,110. Service, $1,200, which is $400 multiplied by 3 years. And extended warranty, 5%, $1,690. Revenue from the service agreement is $1,200. Note that revenue for this portion of the agreement is not recognized at this point. It is deferred and recognized over the 3 years the service is expected to be performed. Deferred revenue is a liability. The extended warranty revenue is 5% of the remaining total. $35,000 less $1,200 equals to $33,800. $33,800 multiplied by 5% equals to $1,690. This revenue is also deferred and recognized over the 2-year warranty period beyond the manufacturer's 3-year warranty. The extended warranty and service revenues could be recognized either as work is performed or on a calculated basis over the periods of time in the warranty and service agreements. The remaining $32,110 is recognized immediately upon delivery of the vehicle to the customer. The remaining revenue is calculated as the total sale, $35,000, minus 3 years of service of $1,200, and minus the amount of extended warranty, which is $1,690. Assuming the customer pays upfront, the transaction is recorded as follows: debit to cash, $35,000, credit to automobile sales of $32,110, credit to deferred services revenue of $1,200, which is $400 short-term and $800 long-term, and credit to deferred warranty revenue of $1,690, all long-term, as it is for the period beyond the manufacturer's 3-year warranty. Keep in mind that revenue is recognized in the period in which it is earned. This is particularly important for revenue transactions that occur immediately before and after the end of the financial reporting period. The term cut-off refers to recognizing revenue in the correct accounting period. We covered it in greater detail in the video FOB shipping point versus destination and the year-end cutoff of transactions. I'm posting the link here and in the description box in case you need to review it. Determining when to recognize revenue and which party owns the inventory being transferred from a seller to a buyer is not straightforward. You will need to read the contract or a purchase order's terms and conditions to determine when the title passes from a seller to a buyer, and which party is responsible for transportation costs, insurance, and other costs during transportation. Other important topics related to revenue recognition are sales returns and allowances, sales discounts, and sales taxes. I will cover those topics in separate videos. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button, and ring the notification bell so you're notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.